Hello, my name is Carlos McWhorter, CPA, and today we have a stock analysis of Target. Target is down about $140 from its high in 2021, and as value investors, we want to see, is Target dropped to value territory? Is it dropped enough to where we feel like we can buy it at a bargain and have a safe investment protected from risk that will continue to grow? So let's take a look at Target and see where we're at. Right now, the stock is trading at about $124. Like I said, in 21, it was traded at about $261. So a significant downtrend since then. The outlook for Target isn't the best. We'll get into that in a minute. But right now, trading at $124. Now, one thing that's is interesting right now, Target is trading at a PE of 13.17. So that's a pretty low PE for a quality established business. So it looks like it could be in value territory now just off of that. But let's look at the numbers in detail and see what we think. Now, looking at the revenues of this business right now, one of the reasons why that stock has slid down, Target has a decline in revenues for 2024, 109 billion in 2023, down 1.6% to the $107 billion, still above that 106 in 2022. So they had a pretty consistent uptrend other than 2017 when they had a decrease in revenues there. But other than that, their more recent decrease in 2024 has been a contributor to that drop in stock price. Let's look at the gross profit. 21 all the way to 29,000. So a little bit of growth there. They had a high of 31 billion. I said billion there. But gross margins are pretty consistent, 29%. But these last 2 years, they've dropped down some, likely due to inflation, but got to keep an eye on that. So margins are pretty consistent, but dropping a little bit over the past 2 years to 24 and 27%. So, okay, not the best trends that we're seeing here. However, with Target being a department store, so it's in a business model that is very mature and the brand itself is very mature, you can expect them to have some years like this where revenues aren't necessarily growing at a high rate every year. Sometimes they're going to be flat. Sometimes they might decline a little bit. But of course, we want them to rebound and continue to grow their revenues. However, this is something that mature companies experience. So past 10 years, 4% growth, past 5 years, 7% growth. This is typically anything lower than 10%. I'd say is low growth, but this isn't bad for mature companies. Mature companies are going to grow slowly over time. So that's where we are with the revenues. Let's take a look at the profitability. What's net profit looking like? So only 1 year of loss in 2015. Every year since then they've gained, but they've had a significant decrease in net profit in 23. But they rebounded pretty solid in 24 at a 48% increase from that drop. So these are typical margins. They look lower compared to some tech companies, but these are typical margins for retail companies. They're going to have higher cost to run their business. They have a lot of facility costs. They have to buy the products to sell. So they're going to have some markup there for their profit, but this is a margin that you can expect for retail. So over the past 5 years, not the best trend with this decrease here, but like I said, mature companies, mature industries, some years are just going to be like this. Not everybody is going to grow at a Meta or Nvidia pace all the time. Retail company, very mature. This is what I would expect to see. So not the best, but it's not bad. Free cash flow. Let's take a look at this. Once they bring in their cash from their operations and spend money in their required reinvestments, their fixed assets, what's left over? That is a free cash flow. We are looking at 2.6 billion in 2015, up to 7.8. But here's the thing, they're down 5 billion, negative 1.5 billion, 3.8. So they hit a peak in 2021 and haven't gotten to that peak yet. So they're back on an uptrend, it looks like. I say uptrend, they've rebounded, but not a solid trend of consistent positive cash flow minus this year. But even without this loss, they were on a downtrend, 7.8 to 5. So no, that's not what we want to see with mature businesses. We want to see consistent cash flows ongoing. So we don't like that. So let's look at the balance sheet. Let's compare that free cash flow to the amount of debt on their books. We want businesses to have cash flow so where they can pay off their debt within 3 to 5 years. So we don't want the debt to be more than 5 times free cash flow. And as you see, we have 2015, 2019, and negative here. Again, we had that negative cash flow. So that was the 3 years where I would say they were not in good shape or decent shape when it comes to their debt to free cash flow levels. We see debt at 13.4 billion here, all the way up to 16, down from last year they had 18. But again, that's 4.3. We like that to be below 3, below 5 if possible. With this negative year, they were in such a bad leverage position this year, looking at their current free cash flow to debt, that blew up their average. So poor leverage. So for the past 3 years, they averaged debt to free cash flow of 6.9 times. They almost had 7 times the amount of debt compared to their free cash flow, which means almost 7 years to pay off their debt. We want companies to generate cash flow at a rate that they can pay off their debt in 3 to 5 years. So their leverage was a pretty bad, okay for the 2024, but on average, looking at the last few years, poor leverage. So we don't like that. So cash flow and leverage is not working in their favor right now. Let's look at their dividend really quick. So right now at the current price, they're paying a 3.6% dividend of about $1.12 per quarter. So that really doesn't mean much. Typically, as you see, companies grow their dividend every year. So from 64, 66, 68, 90, 108, 110, 112. So big jump here, 68 cents to 90 cents, and then 90 cents to $1.08. So you see that they are growing their dividend at a decent pace. Not every year is a big growth. We had a 32 and 20% growth, but typically, okay, 1.8, 1.8, 3%, 3%. Okay, so with a company that's established, we expect them to grow their dividend consistently, and Target is doing that. So that's good. 44.9%. So looking at their current cash flow, 44% of the cash that they generate from their operations, minus the expenditures or capital expenditures, 44% is being paid out in dividends. That's their payout ratio. So when a company has 44.9% and they are a mature company like Target, there's not going to be a whole lot of room to take that extra cash and reinvest it back into the business. There's not like the Target is reinventing their business. If they're a retailer, there's not much more that they're going to do. They're a mature company and they should act like a mature company. They shouldn't be trying to spawn off and do too many different things. That's not going to be a good thing. With that said, that means you should be able to expect Target to continue to grow that dividend, especially as their cash flows continue to grow, which means they have more capacity to grow that dividend. So a payout ratio of below 50%, some people say 30%, but if the payout ratio of a company is below 50% and that cash flow is continuing to grow, you have a potential dividend growth stock there. So I think their dividend policy makes sense for where they are now. With that price coming down some, you get a little premium there at a 3.59% dividend payout. So let's look at their shares outstanding. We want to see a downtrend in shares because as the company takes extra cash flow and repurchases shares, they're taking ownership off the table for other people. So if you own a stock and the company is buying back shares, every time they do it, your ownership, their slice of the pie gets bigger and bigger. You own more and more of the company versus if they're versus if they're selling shares, increasing the share count, then your pie is getting smaller. So as we see, Target is consistently paying back or buying back shares over 520 million down to almost 460 million over the past 5 years. So we like that. That is a good sign. Mature companies should be doing this. Again, there's not going to be a whole lot of opportunity for these mature companies to reinvest back in the business. So they should be paying a dividend and they should be buying back shares, both of which add value to the shareholder. So we do like this. Economic value added. I want to know, based on the amount of capital they had on hand, are they earning a return? And is that return higher than the cost of that capital? The cost of that debt and the cost of the equity that they have. So right now, Target has a return on capital of 15.8%. It's pretty solid compared to the average of their industry, the retail. They are beating them by almost 4%. Weighted average cost of capital, 5.2. Their competitors at 8. So they're beating them there as well, which means they have a value creation rate of about 10.6% versus their competitors at 3. So they have a spread of 7%. So that's amazing. They are blowing it out the water as far as when comparing them to their competitors. They're earning a much more return on capital, or I say a higher rate of return on capital compared to their cost of capital. So Target is creating more value by existing than their competitors. So we like to see that. So with all of that being said, let's look at what I think the valuation is for Target. They're expected to grow at about 4% over the next 5 years. So they've gone to that 10% to 7. Now they're down to 4. This is why that stock price is coming down. Target has been given guidance, has been pretty weak about their future. They know that sales are starting to decline, or the growth of sales is declining, not that sales is declining as a whole. So 4% there, the discount rate, the weighted average cost of capital of 5.8. I believe if I were to buy the stock today, I can expect a terminal value or a multiple of cash flow of 12. I should be able to sell the stock for 12 times the free cash flow 5 years from now. With that said, I believe Target is pretty much spot on as far as their valuation. Their price right now at 124. My intrinsic value estimate is $124.30. So really 6 cents difference. So right on target. So the range that I have is $111 to $136 is what I think their fair value range is. So if you are looking for a dividend stock that is stable and a potentially dividend growth stock, so a company that is growing their dividend at a rate that's higher than normal, this could be a dividend play right here. Not a growth stock, I don't believe. And then some people may think that this company, as we saw in the numbers, when it comes to their free cash flow into the debt, hey, they are possessing more risk and not growing as much. I think it could be overvalued. That's fair as well. But personally, I think it's still a strong brand that can rebound pretty easy. So this is where I have it at about $124, pretty spot on. So let's look at the summary of what we just reviewed. Revenue and margin trends, good, not the best, but what I expect for a retailer that's in the mature state. Same with profitability. Cash flow, 23, they had negative free cash flow, and they haven't rebounded and gotten to that $7.8 billion of free cash flow that they had in 2021. So I say that is a X for me. Balance sheet, their debt averages more than 5 times free cash flow. Primarily to that 1 year, but that's still something we have to keep in mind. Dividend, shares outstanding, value creation, and I believe it's fairly valued. So everything else is a green check mark. So again, this is just my opinion on the stock. I think right now the value of $124 is pretty spot on to what the intrinsic value, the price of $124 is spot on with the intrinsic value of the stock. So one thing about it, you cannot always get deep value into stock, especially when it comes to really good companies. You're not always going to be able to get them at a discount. Sometimes you have to be okay with paying fair price for a great stock or a great company. A 3.59% dividend, I think is solid and will continue to grow. So people who are in my age range, in their 40s and 50s, and we're looking for those dividend stocks to generate income for retirement, this could be a good one for you. So I hope you enjoyed this analysis. I hope to see you in the next video.